Welcome to the Deep Dive. Today, we are getting into the latest financials from Grocery Outlet. They dropped after market close on August 5th, 2025.
And the market reaction was, well, pretty positive right out of the gate.
Yeah, definitely positive. It sort of signals maybe more than just good numbers, right? Like a potential strategic shift from repair mode to maybe a real restart.
Exactly. That's the narrative investors seem to be latching onto. That after-hours jump suggests they see something significant changing. So let's unpack what's driving that.
Okay, let's start with the quick snapshot then. Grocery Outlet delivered a really strong beat on adjusted earnings per share, came in at $0.23.
Which was way above the consensus, right? Like $0.17.
Yeah, beat it by 35%. Huge beat. Now, revenue was $1.18 billion. That was actually a slight miss against the $1.23 billion consensus.
Okay, but still up year over year.
Oh yeah, still healthy growth, up 4.5% year over year.
And operationally, comps and EBITDA.
Comparable store sales grew 1.1%, and adjusted EBITDA landed at $67.7 million. That's a 5.7% margin.
Okay, so putting that together, it really paints a picture of, strong cost control. Profitability gains look really impressive.
Right. That seems to be the main story driving the positive reaction, even with that little revenue shortfall. Efficiency is key.
Absolutely. Cost discipline is clearly paying off.
So what's the deeper story here? Given the market optimism, how is management actually framing this strategically? What are they doing?
Well, the CEO, Jason Potter, was pretty direct about it. He said their, and I quote, "focus on execution is beginning to deliver results, leading to sustainable gains in profitability."
Okay, so not just talk. It connects to that repair to restart idea we mentioned.
Precisely. And they laid out 4 specific strategic imperatives they're working on to kind of make that shift happen.
Yeah.
Moving beyond just fixing things.
All right, let's get into those. Imperative number 1, new store performance. They mentioned rebalancing growth. Like over half the stores open this year are infill locations. What's that mean exactly?
Good question. Infill basically means they're opening new stores within markets where they already, have a presence. Brand recognition, supply chain already there.
So not just planting flags anywhere, smarter growth.
Exactly. It's about smarter, more profitable expansion. They've apparently beefed up their site selection process, running commercial pilots for new stores, and it's working. The 2025 group of stores is already ahead of plan.
And they put numbers on that, the returns.
They did. They're targeting cash-on-cash returns above 20% by year 4 for the combined 2025 and 2026 cohorts. And they even have an aspiration, they said, to push that over 30% eventually by getting starting sales higher.
Wow, okay. That's disciplined, very focused on the return from day one.
Definitely signals a very careful approach to deploying capital.
Okay, second imperative, securing top talent. Always important. But who did they bring in and why does it matter now?
Well, they snagged Matt Deli as the new chief merchandising officer and added 2 new board members back in June.
Oh, yeah.
Mike Kobayashi, who comes from Ross Stores, brings operations and tech transformation experience. And Chip Malloy, who has financial leadership chops from places like Sprouts and PetSmart.
So a new CMO is crucial for their unique treasure hunt model, right? And the board adds, sounds like experience in scaling and finance.
Exactly. It looks like they're building the leadership team for that next phase, the restart phase, strengthening core areas.
Makes sense. Third imperative, addressing execution gaps with systems. This can sound like jargon sometimes. What's the real impact for the operators, the IOs, and the business?
Yeah, but the progress here seems pretty tangible, actually. They're almost done with the last big system update for their independent operators, the IOs. Should be wrapped by end of Q3.
And specific examples.
Okay, so in Q2, they rolled out a real-time order guide. Big deal for inventory visibility, keeping things in stock. And the IOs apparently love it.
And does it actually help sales?
Get this. They said it's already driven a 150 to 200 basis point comp lift on their top 200 items. That's 1.5 to 2% lift just from that tool.
That's actually huge. A measurable impact from a system upgrade.
It really is. And there's more coming. A new arrival guide is set to launch this fall. It expands the ordering window for IOs, helps them plan ahead, grab those opportunistic buys.
Okay. And I think I saw something about fresh categories, too.
Yes, a new forecasting and ordering tool just for fresh meat and produce. It's separate from the main systems, and in test stores, it's driving double-digit sales increases.
Double digits in fresh. That's critical, isn't it, for bringing shoppers back bigger baskets?
Absolutely critical. And they stress this was without cutting prices or extra marketing. It suggests the tool itself is helping IOs manage fresh better, which is, notoriously tricky.
Right, and private brands. Any news there?
They mentioned progress, yeah.
Yeah.
Highlighted the launch of second cheapest wine, under $5 a bottle. Shows they can still innovate and create some buzz around value.
Okay. Sounds very on brand. And supply chain stuff.
Also moving forward, they finished transitioning to a single distribution center in the Pacific Northwest called the Execution Flawless. Better service, lower cost. The next one, in the East, is slated for Q4.
So all these system and supply chain improvements feed into the fourth imperative, right? Improving execution at scale.
Exactly. This is where rubber meets the road. They've got this model store in Oakland, California, kind of a test lab.
What are they testing, and is it actually scalable? Can they roll it out everywhere?
That's the key. They emphasize low cost and scalable. They tweak the layout, signage, merchandising, use those new fresh ordering tools.
And the results?
A middle single-digit comp lift compared to control stores, which is significant. And because the changes are designed to be affordable and easy to replicate, they see a path to rolling this out across the fleet for compounded growth. Not huge capital spending needed for it.
And supporting the operators through this.
Yes, strengthening support tools, training for the IOs, fostering more collaboration on piloting new ideas, empowering the people on the ground.
Okay, so that's the strategic side. How does all this translate into the detailed financials and their outlook for the rest of the year?
Right, let's connect the dots. That $1.18 billion in net sales was, like we said, driven by new stores plus that 1.1% comp growth.
And the comp breakdown. You mentioned traffic versus basket size.
Yeah, transactions were up 1.5%, so more people shopping. But average transaction size was actually down slightly, 0.4%.
So getting folks in the door, but they're buying a bit less each trip. Are they working on that?
They are. It's definitely a focus, and the encouraging part is those test store results we talked about. They're showing signs of reversing that larger baskets, more items per trip, so progress is being made there.
In store count, where did they end the quarter?
Opened 11 new ones, closed 2 in Q2, keeps them on track for their full-year target. 33 to 35 net new stores. That'll bring them to 552 stores in 16 states by year-end.
Got it. Gross margin landed at 30.6%, down a bit year over year, but up from Q1.
Correct. Down 30 basis points from last year, but up 20 basis points sequentially from Q1. They credited better inventory management for that sequential improvement.
And operating expenses, SG&A.
I actually saw some improvement there. Leveraged by 10 basis points year over year, down to 28.5% of sales. So slightly more efficient.
What drove that?
It was mainly because some temporary elective commission support they were giving IOs related to a prior system conversion has now ended. That benefit is fully baked in now, so it won't help year-over-year comparisons going forward.
Okay. So a one-time kind of structural benefit lapsing.
Right. But they do expect substantial net savings from their broader cost-cutting program to kick in during 2026.
Okay. Now, they took some restructuring charges in Q2, about $11 million.
They did. Asset impairments, lease termination costs. Part of that plan. But the big news is that the plan is now substantially complete. Total charges for the year expected around $63 million.
Substantially complete. That sounds like a milestone. What does that unlock?
It's a big deal. It basically means the expensive cleanup work, the restructuring noise, is mostly over. Frees up cash, frees up management attention to focus purely on growth and operations, not fixing past issues.
Okay. And the bottom line numbers for Q2.
Net income was $5 million, which was down from $14 million last year. Adjusted net income also dipped a bit, $22.8 million versus $25.1 million. And adjusted EBITDA was pretty flat year over year at $67.7 million.
But cash flow looked strong, and the balance sheet.
Very strong. Net cash from operations for the first half of the year was $132.6 million. Yeah. That's way up from $49.4 million last year. Big jump.
Wow.
Yeah. And they ended Q2 with $55.2 million in cash, plus $25 million available on their credit line. Net debt is around $474 million, putting net leverage at a very comfortable 1.7 times adjusted EBITDA.
So financially flexible, which supports that restart idea.
Absolutely. They have the resource.
Okay, let's talk guidance. Full year 2025, revenue outlook.
Reaffirmed. $4.7 billion to $4.8 billion. No change there.
But the EPS.
Yeah.
That was a headline, right?
That was the big news. They raised the adjusted EPS guidance, now expecting 0.75 cents to 80 cents per share. That's up from 0.17 cents to previously.
And why the raise? Primarily lower interest costs.
Exactly. Favorable assumptions on interest expense were the main driver. They also lowered guidance for net interest expense itself to about $27 million, down from $32 million. And share-based comp guidance also came down a bit.
Okay. What about comps and margins for the full year?
Those are reaffirmed. Comp store sales still expected at 1% to 2%. gross margins in the 30% to 30.5% range. And adjusted EBITDA guidance held steady at $260 million to $270 million.
And quick look at Q3 guidance.
For Q3 specifically, comps expected between 1.5% and 2%. 9 net new stores opening. Gross margin 30% to 30.5%, same as the full year. Adjusted EBITDA $63 million to $67 million. And adjusted EPS projected at $10.19 for the quarter.
So steady, measured progress expected to continue in Q3.
That seems to be the outlook, yes.
How does this fit into the bigger picture, the consumer, the industry? What's the context?
Well, management said they haven't seen huge shifts in consumer behavior recently, and historically their model does well when consumers are stressed, during recessions or high inflation. Value focus helps.
And things like changes to S&P benefits, could that actually help them?
They think so, yes. Changes to programs like S&P could drive more shoppers towards value retailers, which plays right into Grocery Outlet's hands.
And the wider industry.
We're seeing food inflation moderate, but value players are definitely gaining traffic. You look at some of the dollar stores, their peers, they've also raised outlooks. It suggests that demand for value, maybe some trade down, is pretty resilient right now.
So Grocery Outlet is positioning itself as that value destination.
Right. But they emphasize value isn't just price for them. It's price, quality, service, that whole package. And crucial for their model, that opportunistic supply, the treasure hunt stuff, still abundant. No shortage of deals for them to find.
That treasure hunt model is so unique. Does it create inventory headaches, or is it mainly an advantage? Seems great for us shoppers.
That's a fair question. It definitely adds complexity compared to a traditional grocer. But based on the margin improvements and the inventory management comments, they seem to be handling that complexity effectively. It's a double-edged sword, maybe, but the customer loyalty and the unique deals it enables are a massive advantage.
Makes sense. And digital or e-commerce, where does that fit?
They acknowledge it's an opportunity down the road, but it's clearly not the main focus right now. They seem laser-focused on nailing the in-store execution and the I/O model first. Optimize the core.
Okay. So putting it all together for investors, beyond the headline numbers, what's the real takeaway from this call, especially given that positive market reaction?
I think it really boils down to that narrative shift we talked about. The market liked the big EPS beat, loved the raised guidance, and clearly sees management executing on cost control and operational fixes.
And the restructuring being done is a big signal too, right?
Huge signal. That substantially complete language means the expensive, distracting part is over. It unlocks a leaner cost base, frees up capital. Investors are looking past the repair phase now. They see a clearer path to growth and getting those margins back up. It feels like a genuine restart.
So a real pivot point from fixing problems to building momentum. What should investors be watching for next? What are the key catalysts?
Good question. Definitely keep an eye on updates about those remodel economics. Are the model store results holding up as they expand? Also, more data on those inventory tech KPIs. Is the sales lift sustainable?
Okay.
What else? Holiday season traffic trends will be crucial for all value grocers. And then looking further out, can they actually accelerate unit growth beyond the current 33, 35 stores a year once this reset is fully done? That's a big question for 2026 and beyond.
And use of cash.
Exactly. With cash flow improving, what do? Pay down debt, maybe some small, smart acquisitions. That'll be key too. It's shaping up to be a multi-year story, potentially a re-rating of the stock if they keep executing.
Okay, lots to watch. Now, with all this talk of potential turnarounds and re-ratings, you might be getting some investment ideas. But first, our standard, very important reminder.
Absolutely. This next bit is purely for informational and entertainment purposes. It is absolutely not financial advice. Always, always do your own research, your own due diligence, and please consult with a qualified financial professional before making any investment decisions.
Couldn't have said it better. Okay, disclaimer delivered. So with that caveat firmly in place, what's a potential trade idea stemming from this restart narrative?
All right, here's one for the bulls, let's call it.
Yeah.
The operational turnaround triumph long. The core idea, the thesis, is that the market still hasn't fully priced in how powerful these small operational improvements could be when they compound across the whole store base.
Like those test store results.
Exactly. Mid-single-digit comp lifts, double-digit fresh sales growth. Importantly, without just slashing prices or throwing marketing money at it. That suggests real improvement in the customer experience and, crucially, better profitability for the independent operators.
And the I/O model itself is a strength.
Huge strength. Low voluntary turnover, they said. IOs are embracing the new tools. That's a competitive moat that's hard to replicate. So the trade.
Well, the straightforward approach is just a long position in vol shares. But if you have really high conviction in this multi-year story,
You can consider amplifying it, maybe with a longer term, deep in the money call option, something like, say, a January 2027 $10 strike call. It reflects belief that this repair to restart thing leads to sustained higher valuation, maybe even faster store growth later on, catching those value grocer tailwinds.
okay, that's the conviction play. What about something for those who see the potential but are maybe a bit cautious after the stock already jumped?
Right, maybe a little nuance is needed. Let's call this one the post-pop patience hedge. The thesis here is simple. Yeah, the story is good, maybe great long term, but the stock did just pop aggressively after hours.
So risk of a short-term pullback, profit taking.
Exactly. There's a reasonable chance things cool off a bit as the initial excitement fades. That slight revenue miss, the overall comps still being relatively modest, could give some shorter-term folks pause.
So how would you structure that hedge?
Well, if you are initiating that long position but want some near-term protection, you could look at a short-term, out-of-the-money bear put spread. For example, maybe sell the September 2025 $14 put and buy the September 2025 $12 put.
Okay, so that limits your hedge cost, but still gives some protection if there's a modest dip.
Precisely. You're trying to capture some premium if the stock does pull back slightly in the near term, just cushioning your main long position without ditching the core belief in the turnaround.
Interesting ideas. Again, not advice, just food for thought.
Absolutely. So, wrapping it all up, Grocery Outlet really put up a strong adjusted EPS number, beat expectations there, and importantly, raised the full year guidance for it, driven by that cost control and clear progress on the operational fixes.
And the market noticed. That immediate positive reaction underscores the confidence investors seem to have in this strategic shift, moving from repair to restart. The focus on empowering IOs, fixing in stock levels, making new stores more profitable from the get-go. It sets a positive stage.
It really does. And maybe here's a final thought to leave you with. As Grocery Outlet keeps refining this really unique operating model using tech for efficiency, how might its specific value proposition, that treasure hunt, the IO partnership, start to reshape what consumers expect from grocery stores more broadly? And what could that mean for the competition down the line?
Something to definitely think about. Remember, everyone, this deep dive was for your information and entertainment, not financial advice. Please always do your own homework. Join us next time for another deep dive into the numbers.